These days, the catchphrase is sustainable and responsible investment. It's looking at issues like social impact, environmental impact, investment prospects. Let's find out what this is all about. A report aims to determine the current state of the trajectory for sustainable investments, looking at key markets like Kenya, Nigeria and South Africa. We're now joined by Graham Sinclair, who's a sustainable investment strategist at Cinco. Thanks so much for your time, Graham. First and foremost, how do investors view Africa when it comes to SRI ratings?
Well, we've got a range of opinions, and that's some of the approach that we took on this project. We spent 23 months interviewing people both on the continent and outside the continent, because you need to pick up the story from both ends. And also from the point of view that the largest institutional investment market in Africa is actually South Africa. There's a lot of money heading north of the Limpopo, for example. So we find in the main, and we have some of our key findings, references the first thing that investors are looking for. They're looking for risk-adjusted return. They're looking for correlated returns. They want returns from Africa that are going to be different to some other geographies and or themes that they're choosing to invest in. Next to that, though, and fundamental to the research report that we were able to conduct, is they're looking for good corporate governance. And it's very basic when you think about it, but so very important. Net for an investor, you want to see your money come back to you. That's what corporate governance is about.
I mean, obviously the perception is when we talk about corporate governance, we're talking about all sorts of measures to alleviate corruption, but apparently the definition is broader than that now. We're looking at environmental standards, we're looking at social impact. How important are those kinds of facets?
Absolutely, and so the key phrase, perhaps for your listeners to walk away from and from this report, is ESG, Environment, Social Governance. ESG is pretty much a catchphrase that we use to describe sustainable investment. And very much these are interrelated. So you can have a well-run company, but if it's not thinking through what it's doing with its pollution, or perhaps reducing the footprint of water that it's using, how many liters does it take to make 1 liter of wine or beer, then they're not managing all their resources to the best of their ability. They're not being most efficient with shareholder capital, but also with natural capital that's available to them.
Let's talk about those shareholders, because effectively they can institute checks and balances. I mean, if we're looking at South Africa, for instance, some of the pension funds, PIC for instance, and others have signed up to the so-called UN Principles of Responsible Investment, and effectively are saying to the companies in which they invest, we want to see your track record. Are shareholders vigilant in that way?
It's kind of tough to say. I mean, we've seen a large growth since 2006, April. New York Stock Exchange is where they launched around 30 different pension funds, asset owners who signed on. And the GPF, the Government Employees Pension Fund, was an original signatory and is a board member of the PRI. Just this morning, we had the chairman of the PRI here in Johannesburg to help launch the Code for Responsible Investment in South Africa, which is a further development and a reaction to corporate governance, to King 3, now looking to investors to take it up a notch in terms of following some basic principles. There's 5 principles. For me, the most important really is the 5th principle. It's about transparency. It's about investors explaining to the people whose money they manage. These are professional investors that are managing other people's money, trying to explain the approach they take and being much more transparent with their decisions.
Now, for a listed entity, it's probably easy, I'm making an assumption here, it's probably easier to monitor their performance because you get financial reports, you are allowed to investigate a little bit more. A lot of money is coming through the private equity space where it's really difficult to find out how far the tentacles of that company go. Private equity listed entities, how do they fare?
So that was one of the fundamental reasons why the IFC commissioned this report that Cinco did together with Rescura. Rescura have a private equity business and asset consulting. And that's perhaps why we had to do some deep digging and took a while to do. There was a counterintuitive finding though, Loretta. The counterintuitive finding was that there's relatively more use of ESG factors by private equity funds than listed equity funds or general asset management. And first of all, we weren't quite sure why, but as we kept asking the investors that we spoke to, the private equity funds, it became fairly apparent. If you're a private equity investor, you going in, you can't come out tomorrow afternoon. You're going in for 5 to 10 years, particularly in Africa where the model of private equity is about active ownership. You're trying to take a small growing business and grow that larger. You are the growth capital being made available to that company. So the a positive opportunity that we find for private equity is that private equity funds are integrating ESG factors. We found 1 in 2 funds in the last 3 years have managed money for development financing institutions who have a mission to make sure that their capital, their assets are being deployed in frontier markets, but that they're being deployed in a way that doesn't impact negatively on the environment and people and so on.
Some people who are a bit more skeptical will say, yeah, governance is very important, but we're also here to make money. And if we're going to be looking for companies that are environmentally astute, socially aware, we want to ensure that we can also get a return on that investment. And consequently, we're starting to see SRI funds or talk of SRI funds being set up. What's the impetus for that?
Well, our finding kind of illustrates some of the tension. So if you think in terms of what's on the label and what's inside, that's where we found, for example, less than 1% of assets under management in this 3-country study were so-called ESG labeled. It was on the label in the same way that you would have a hybrid car or you'd have a biodynamic wine, for example, versus where ESG is integrated at some point in the process. We found that's where we found $125 billion in 2010 was invested in some way using ESG factors. Now, in fairness, and I'm an analyst, of course, it's self-reported numbers, and we'll take that further in future years and drill down deeper, roll up our sleeves. But definitely there is a substantial asset base today in Africa looking for investments, and when they're looking for investments, they want to know that company is a well-run company.
Capital markets and deepening capital markets is a major challenge in Africa. As you said, it's easier to monitor JSE listed companies because the JSE is a global bourse, one of the top 20, etc., etc. What happens when we're talking about other capital markets in Africa? Because a lot of the work is being done in Nigeria, in Kenya and South Africa. The hotspots, the traditional emerging market destinations for investors. What happens to those on the beaten track, off the beaten track?
And those are, very much beyond frontier markets. Those are high risk markets to be investing in. And, I'm not sure if the graphic is available, but one of the graphics that I found very interesting coming from the study is a graphic where we tracked the MSCI Emerging Markets Index over the last decade, pretty much a benchmark into emerging markets. It doesn't include some of those frontier countries, but there you can see over time relatively even how South Africa's portion of that index has reduced as Brazil and China have got bigger and bigger. The other huge takeaway that looks like a big bite out of a chocolate bar is the effect of the global financial crisis in 2008 and 2009. I've just come back from Kenya a couple of weeks ago. There's a great appetite to move forward and to integrate into capital markets internationally, to be appealing to international investors. The awareness about corporate governance is very, very high. Sometimes there's a skills gap, sometimes there's just a knowledge gap. And there will be a time lag as they move through the different stages, a basic market, a frontier market, and an emerging market.
I mean, Kenya, for instance, just focusing on that example, they started to introduce changes, introducing 3 days trading, for instance, T+3, recategorizing the index. And you could say, the next step logically is to introduce an SRI index. I know the JSE has some sort of a sustainability index where you can identify of the top 80 companies which have adhered to social responsibility principles the most. How can we introduce that kind of system across the board in Africa?
That's a great segue. Thank you, Lorata. That's we give 5 recommendations, and the 5th recommendation that we give is about keeping score. At the end of the day, you mentioned the word impact earlier. It's about what is the impact. It's very good having the intention, but what we're finding in the sustainable investment industry now is investors have kind of got through this idea of, we can actually invest without thinking through negative externalities and putting that into our investment decision. But what is going to be the impact of that investment? And that's very much where keeping score, having a benchmark index, or developing a new index, for example, would be very, very helpful. And we recommend that both at a sub-Saharan Africa level, potentially at a country level or an Africa level, we could develop a sustainability index.
All right, thanks so much for your time, Graham Sinclair, Sustainable Investment Strategist with Cinco, talking to us a report launched today in terms of just conscientizing us a little bit more about sustainable responsibility investment strategies.